For most of modern economic history, there has been a basic assumption that people rarely questioned. When the cost of living rose, wages eventually followed. It did not always happen immediately. Sometimes it lagged. Sometimes it was uneven. But over time, incomes adjusted enough for most people to regain their footing. That assumption shaped everything: where people chose to live, how much debt they took on, whether they felt safe renting, buying, or starting a family. It was the quiet foundation underneath everyday life. What is different now is not that prices went up. That has happened before. What is different is that the pressure never fully eased, even as the headlines moved on. Inflation slowed. Official numbers cooled. Markets adjusted. But for millions of households, the weight of everyday expenses did not lift. In many cases, it intensified. People feel it in small, persistent ways. The budget that used to work no longer does. The raise that looked decent on paper disappears almost immediately. The sense that something is off, but hard to pin down. This video is not about panic. It is not about predicting a crash. And it is not about one single expense spiraling out of control. It is about why cost of living pressure is now spreading faster than wages can keep up, and why that matters far more than any single headline number. Because what we are seeing is not one problem. It is a pattern. Across different cities, industries, and income levels, the same story keeps repeating. People are technically employed but financially tighter. Costs are rising in ways that are harder to avoid, while income growth is slower, more fragile, and less reliable than it appears. And once that balance breaks, it rarely fixes itself quickly. For years, rising costs were explained as temporary. Supply chains would normalize, rates would stabilize, wages would catch up. Some of those things did happen, but the pressure did not retreat. It simply shifted. Instead of one obvious spike, there are now multiple overlapping stresses: rent, insurance, utilities, transport, healthcare, local fees, each one manageable on its own. Together, increasingly heavy. This is why so many people feel stuck between two conflicting messages. On one hand, the economy is said to be stable. Jobs numbers look fine, growth has not collapsed, markets appear calm. On the other hand, everyday life feels more expensive, more constrained, and less forgiving than it did just a few years ago. That gap between the data and the lived experience is where tension builds. It is also where major shifts tend to begin. Historically, when wages fail to keep pace with basic living costs, the effects do not show up all at once. They show up quietly, in delayed decisions, in fewer moves, in people staying put longer than they planned, in households absorbing stress rather than reacting to it. The system does not snap. It grinds. What makes this moment unusual is how widely that grinding pressure is now spreading. It is not confined to one city. It is not limited to one income bracket. It is not restricted to one sector of the economy. It is showing up wherever costs adjust faster than paychecks can. And that raises a deeper question. If wages are no longer the mechanism that restores balance, then what is? To understand that, we need to look at where the pressure is coming from, how it is moving through the system, and why it feels so persistent even as conditions supposedly improve. That means looking beyond any single expense. It means understanding how income growth actually works, how fixed costs behave differently from discretionary spending, and why certain pressures spread even when others ease. Most importantly, it means recognizing that this is not about individual failure or bad decisions. It is about structural timing. Costs can move quickly. Wages move slowly. And when that gap widens across enough parts of everyday life, the effects compound. In the sections that follow, we are going to break this down piece by piece. First, why wages are far less flexible than many people assume, even in a strong job market. Then, how housing and rent became one of the fastest pressure points. not because of speculation alone, but because of how often those costs reset. After that, the less discussed expenses that quietly drain household budgets, even when headline inflation cools. And finally, why this pressure spreads from place to place instead of remaining contained. None of this requires a crash to matter. Because when cost of living pressure spreads faster than wages, stability becomes fragile long before anything officially breaks. And that is where we are now. Why wages are falling behind, even when jobs exist. To understand why cost of living pressure is spreading so widely, we need to start with wages. Because for most people, wages are the only real shock absorber they have. When prices rise, the assumption is that income eventually adjusts, either through raises, job changes, promotions, or a tighter labor market that forces employers to pay more. That mechanism still exists, but it has become slower, weaker, and far less reliable than it appears on the surface. One reason is that wages are inherently rigid. Unlike prices, wages do not reset constantly. They are negotiated infrequently, often annually, sometimes less. Employers lock them in based on expectations, not on real-time changes in living costs. When conditions shift quickly, wages lag by design. This matters because many of the costs people face today adjust far more frequently than income does. Rent renews yearly or even faster. Insurance premiums reset annually. Utilities fluctuate. Transport costs move with fuel and maintenance. Local taxes and fees creep upward. Wages, by contrast, tend to move in steps, not continuously. Even when wages rise, they often do so unevenly. Some workers see meaningful increases, others see none at all. Many see raises that look reasonable on paper, but fail to keep pace with multiple rising expenses at once. This creates a situation where employment alone no longer guarantees stability. A person can be working full-time, earning more than they did a few years ago, and still feel worse off. Not because they are mismanaging money, but because the relationship between income and expenses has changed. Another factor is how companies respond to pressure. When costs rise, businesses do not immediately raise wages. They first protect margins. They slow hiring. They reduce hours. They delay raises. They restructure roles. In many cases, they increase workloads instead of pay. Wage growth tends to come last, after other adjustments have already been made. This is why job numbers alone can be misleading. An economy can appear strong on paper while households quietly absorb stress. People stay employed, but they take on more risk. They draw down savings. They delay moves. They tolerate conditions they would not have accepted before. That behavior masks pressure for a time, but it does not remove it. There is also a psychological element to wage stagnation that often goes unnoticed. When people feel uncertain about future income, they behave differently even if their current paycheck is stable. They become cautious. They avoid large commitments. They resist relocation. They stay in roles longer than they otherwise would. This reduces mobility, which in turn reduces wage competition. In other words, wage pressure weakens itself. Another important shift is the nature of recent wage gains. In many cases, the strongest increases came during a short, intense period when labor markets were unusually tight. Those gains were not evenly distributed, and they were often reactive rather than structural. Once conditions normalized, wage growth slowed again, but higher costs remained. That creates a ratchet effect. Costs move up quickly. Wages move up briefly. Costs stay elevated. Wages stall. Over time, that gap becomes visible in household budgets. People may not track it consciously, but they feel it. They notice that more of their income is spoken for before discretionary spending even begins. They notice that saving feels harder, even with the same habits. This is not a failure of effort. It is a timing problem. Wages are slow by nature. Costs are not. And when multiple costs rise faster than income across enough categories, the pressure spreads. Not because of one dramatic event, but because the system no longer self-corrects the way it once did. This is the foundation of what we are seeing now. Income growth exists, but it is not keeping pace with how quickly everyday expenses reset. And once that imbalance takes hold, it does not stay isolated. It shows up first where costs are most flexible and unavoidable, which brings us to housing, and why rent in particular became one of the earliest pressure points. Why housing and rent became the first pressure point. When cost of living pressure starts to spread faster than wages, it does not appear everywhere at once. It shows up first where costs reset quickly, where people have the least flexibility, and where delaying payment is not an option. That is why housing, and especially rent, became one of the earliest pressure points. Housing costs behave differently from many other expenses. They are large, recurring, and difficult to escape. Moving is expensive. Staying put can be just as costly, and once a lease renews or a mortgage payment resets, the change is locked in. Rent, in particular, adjusts faster than most people expect. Unlike wages, which may be reviewed annually or less, rent resets on a fixed schedule. Each renewal becomes a moment where market conditions are applied directly to a household's budget. For years, that mechanism pushed rent upward almost everywhere. Demand was strong, supply was constrained, and migration patterns amplified pressure in specific regions. What matters now is not just that rent rose, but that it rose faster than income across many different cities at the same time. That broke an important assumption. Historically, higher rent in one place encouraged people to move elsewhere. Pressure dispersed. Markets balanced themselves through migration. But when multiple cities experience rising rent simultaneously, that release valve narrows. People stay put not because conditions are ideal, but because alternatives are no longer meaningfully cheaper. The cost of moving rises. The benefit of moving shrinks. That traps pressure in place. Another reason rent shows stress early is because it reflects both demand and confidence. Landlords raise rent when they believe tenants can absorb it. They hold firm when they believe demand will remain strong. When that confidence weakens, behavior changes. What we are starting to see in many markets is not an immediate collapse in rent, but a hesitation. Rent increases slow. Incentives quietly return. Listings sit longer. Renewals become negotiations rather than ultimatums. These shifts are subtle, but they matter. They signal that the relationship between wages and housing costs has stretched too far, even before anything officially breaks. Home prices behave differently. They are slower to adjust. They are influenced by credit conditions, interest rates, and expectations. Sellers resist lowering prices. Buyers delay decisions. Transactions slow before prices fall. Rent does not have that luxury. Rent is paid monthly. It reflects real-time affordability. It forces households to confront cost pressure immediately without the buffer of long-term financing. That makes rent one of the most sensitive indicators of strain. It also explains why housing stress often appears fragmented. In some areas, rent remains high but stops rising. In others, concessions appear while headline prices hold. In still others, demand softens abruptly as residents leave or consolidate households. From the outside, this can look contradictory. In reality, it is the system adjusting unevenly. The key point is that rent does not need to collapse to matter. It only needs to stop behaving the way it did before. When rent growth slows while wages remain stagnant, pressure does not disappear. It simply stabilizes at a higher baseline. Households do not feel relief. They feel stuck. That stuckness has consequences. People delay moving closer to work. They take longer commutes. They accept smaller spaces. They postpone life decisions. They remain in jobs they would otherwise leave. All of this feeds back into the broader economy. Less mobility reduces wage competition. Reduced wage competition reinforces income rigidity, and that, in turn, keeps cost of living pressure elevated even when certain prices stop rising. This is why housing, and rent in particular, became one of the first visible signals. Not because it caused the problem, but because it revealed it. As rent pressure spread across cities and income levels, it exposed how little room many households actually had. And once that room disappears, even small increases elsewhere become destabilizing. Which brings us to the next layer of pressure. Because while housing is the largest single expense for most people, it is no longer the only one adjusting aggressively. Some of the most impactful costs today are the ones people rarely talk about because they do not rise all at once, and they do not make headlines. That is where the pressure compounds. The overlooked costs. Quietly tightening household budgets. By the time housing and rent begin to strain household budgets, many people assume the worst of the pressure has already arrived. In reality, that is often only the beginning. The most destabilizing cost pressures are not always the largest ones. They are the ones that rise quietly, reset frequently, and offer little room for adjustment. These costs rarely make headlines, but together, they reshape everyday life. One of the most significant is insurance. Auto insurance, home insurance, health coverage, and supplemental policies have all risen sharply in many regions. These increases are often justified by higher repair costs, increased risk exposure, or broader financial conditions. From the household perspective, the reason matters less than the timing. Insurance premiums typically reset annually. When they rise, the increase is immediate and non-negotiable. There is no option to delay payment without losing coverage. Unlike discretionary spending, insurance cannot easily be reduced without increasing personal risk. This makes it one of the fastest ways pressure spreads. Utilities follow a similar pattern. Energy costs fluctuate, but utility bills rarely fall meaningfully over time. Infrastructure upgrades, regulatory changes, and environmental pressures tend to push costs upward, even when consumption remains stable. These increases are incremental, often small on their own, but persistent. Transport is another area where cost pressure accumulates quietly. Car ownership has become more expensive across multiple dimensions. Purchase prices remain elevated. Financing costs are higher. Insurance premiums have risen. Maintenance and repair costs increase alongside parts and labor. For households that rely on a vehicle to work, these are fixed costs. They cannot be avoided without significant lifestyle changes. Public transport offers limited relief in many areas, and fare increases often follow operational costs rather than household affordability. Healthcare and related services add another layer. Even for insured households, out-of-pocket expenses rise through higher deductibles, co-pays, and uncovered services. These costs are unpredictable, which makes budgeting harder and increases financial anxiety. Childcare and education-related expenses behave similarly. Fees adjust regularly. Availability fluctuates. Alternatives are limited. And for working households, opting out is rarely feasible. What makes these pressures particularly powerful is not their size in isolation, but their timing. Many of these costs adjust independently of one another. They do not wait for wages to catch up. They do not coordinate with inflation cycles. They simply reset when contracts renew or providers adjust pricing. This creates a constant sense of financial motion. Households feel as though they are running just to stay in place. Even when one cost stabilizes, another rises. Even when income increases slightly, another expense absorbs it. Over time, this erodes resilience. Savings decline. Emergency buffers shrink. Flexibility disappears. People become more sensitive to small shocks. A single unexpected expense carries outsized consequences. This is why cost of living pressure can spread without a clear trigger. There is no single bill that breaks the system. Instead, pressure accumulates through dozens of small adjustments that rarely attract attention. From the outside, the economy may appear stable. Internally, households feel constrained. This gap between macro stability and micro stress is where broader shifts begin. People change behavior quietly. They cut back in ways that are not immediately visible. They delay purchases. They consolidate households. They take on informal work. They avoid risk. These responses are rational, but they also slow economic activity. And once enough households behave this way at the same time, the effects become visible elsewhere. Which brings us to an important question. If cost of living pressure is not isolated to one expense and not confined to one city, why does it spread instead of dissipating? Why does pressure migrate rather than resolve? To answer that, we need to look at how these stresses move through the system and why they tend to reinforce each other. That is where we go next. Why cost of living pressure spreads instead of resolving. Once cost of living pressure takes hold, the expectation is that it eventually eases. People assume prices fall, wages rise, or conditions normalize. That belief is rooted in past cycles, where pressure was often localized or temporary. What we are seeing now behaves differently. Instead of dissipating, pressure spreads. To understand why, it helps to think about how modern economies actually adjust. When pressure builds in one area, such as housing or utilities, households respond by cutting elsewhere. They spend less, delay decisions, and become more risk-averse. That behavior protects individuals in the short term, but it creates second-order effects. Reduced spending affects local businesses. Slower business activity affects hiring. Weaker hiring limits wage growth. Limited wage growth reinforces household pressure. The loop feeds itself. This is why pressure does not stay contained. It migrates. A city with rising costs pushes residents outward. Those residents bring demand to new areas, raising costs there. Employers follow labor availability, not affordability. Infrastructure lags, population shifts. What begins as a local problem becomes regional, then national. At the same time, costs rarely fall evenly. When demand softens, businesses resist lowering prices. They cut costs instead. They reduce service levels. They delay investment. They raise fees elsewhere to compensate. This keeps pressure in the system even as activity slows. Policy responses often arrive late, and when they do, they target symptoms rather than timing. Wage support comes after costs have already reset. Housing supply responds slowly. Infrastructure investment takes years. Regulation lags reality. By the time adjustments are visible, households have already adapted to survive. Those adaptations are sticky. People who consolidate housing do not immediately separate again. Workers who accept longer commutes do not easily reverse them. Households that abandon savings habits struggle to rebuild them quickly. The system resets at a lower level of flexibility. This is why cost of living pressure feels persistent even when conditions improve on paper. It is not that relief never comes. It is that it arrives unevenly, slowly, and often too late to restore prior stability. Another reason pressure spreads is psychological. When people lose confidence that income will reliably cover expenses, behavior changes even before circumstances worsen. Caution replaces optimism. Stability becomes the goal, not growth. This reduces dynamism across the economy. Fewer moves, fewer risks, fewer transitions. That dampens wage pressure further, reinforcing the original imbalance. Importantly, none of this requires a dramatic event. There does not need to be a crash. There does not need to be a spike in unemployment. There does not need to be a single moment where everything breaks. The system can remain outwardly functional while becoming internally strained. That is often how long periods of adjustment begin. Cost of living pressure spreads quietly because it is experienced individually, not collectively. Each household adapts on its own. Each adjustment makes sense in isolation. But taken together, those adaptations reshape the broader economy. This is the stage where we are now. Not a collapse, not a recovery, but a rebalancing that places more weight on households than before. Understanding this does not mean expecting the worst. It means recognizing that stability today does not look like stability in the past. And it means paying attention to where pressure shows up next. Because once cost of living pressure begins to spread faster than wages, the question is no longer whether something will change. It is what form that change will take and who it will affect first. That is what we will continue to track. What this shift really means. When cost of living pressure spreads faster than wages, the effects are rarely immediate or dramatic. There is no single breaking point, no obvious moment when the system fails. Instead, pressure becomes normalized. People adjust quietly. They make trade-offs they never planned to make. They accept constraints that once would have felt temporary and begin to treat them as permanent. This is how economic shifts usually unfold in real life. Not through headlines, but through behavior. The danger is not that everyday life suddenly becomes impossible. It is that it becomes narrower, fewer options, fewer moves, less room for error. When households operate with less flexibility, everything downstream feels tighter. Decisions become defensive rather than aspirational. Stability replaces growth as the primary goal. From the outside, this can look like resilience. From the inside, it feels like friction. What makes this moment different from previous periods of strain is how widely the pressure is distributed. It is not isolated to one city, one industry, or one income level. It appears in different forms across different places, but the underlying dynamic is the same. Costs adjust quickly. Wages do not. Once that imbalance becomes embedded, it does not unwind easily. Relief does not arrive all at once. It comes unevenly, and often after households have already adapted. That adaptation shapes the next phase of the economy. People stay where they are. They delay transitions. They reduce risk. They become cautious in ways that are hard to reverse. These are not irrational responses. They are the natural outcome of prolonged pressure. The result is a system that remains functional, but less flexible. Understanding this shift does not require pessimism. It requires attention. The early signs are not found in dramatic events, but in small changes that repeat across different areas of everyday life. Rent negotiations that feel different, expenses that no longer feel temporary, raises that fail to create breathing room. These signals do not tell us exactly what comes next, but they do tell us where to look. As this pressure continues to move through the system, it will show up in new places. In housing decisions, in employment patterns, in how cities change, in how people redefine stability. Those shifts matter long before they appear in official data. Tracking them is not about predicting collapse. It is about recognizing change while it is still subtle. That is what we will continue to do.